Our first session for today is a market outlook, economic outlook by Ms. Julia Goh, Senior Economist, Malaysia, for the Global Economics and Market Research United Overseas Banks. Just a short bio about Ms. Julia Goh. Ms. Julia is a Senior Economist at UOB Malaysia, responsible for the UOB Global Economics and Markets Research Team coverage of Malaysia. She has over 12 years of research experience working in the stockbroking industry. Prior to joining UOB Malaysia, Julia extensively covered Malaysia and regional economies at an ASEAN investment bank and contributed to the research team, being ranked among the top 3 in-country research on Malaysia at the Asia Money Brokers Pool for 7 consecutive years. Without further ado, I would like to invite Ms. Julia Goh for the economic outlook.
All right, can you see my slides now?
Yes.
Okay, great. So as the picture shows, I think it pretty much sums up what our thoughts are, that we see rays of sunshine, right? Just as, you know, the markets have been performing, the equity markets, you know, the market optimism about the reopening of economies, you know, about hopes of a vaccine. But at the same time, we think we are not completely out of the woods yet, okay? And so some of the key themes, I think, that are very relevant going into the second half and into 2021, I think would be the shape of this recovery, right? So, you know, we've seen, we went into a big lockdown, a great lockdown globally, right? And some economies, actually most economies have reopened, and we are seeing some form of recovery taking shape, right? But because of you know, worries about a second or a third wave, right? Naturally, there's a lot of caution still lingering, and I think naturally, because of the cautious reopening and the caution about a potential second or third wave, it means that the shape of the recovery would be a U-shaped recovery, right? And what it means is that you will see at least 2 quarters of very weak growth. Okay, I think for most economies it would be a contraction, right? Some, like China or Vietnam, could see positive growth, but majority of economies would see contractions for at least 2 quarters. So it means that there is a recession. And what happens is that, you know, as economies rebound after the reopening, there's still a worry about, you know, naturally that when you reopen, right, people, society let their guard down, and sense of complacency in. And as what we have seen in countries like Australia, Hong Kong, right? Also, in some sense, Malaysia, you know, because of the recent, there is a worry that you know, because of the complacency, right, we could see another wave of cases coming back. So what happens is that people ask, what about possibility of a W-shaped recovery, right? And this is what we are seeing. It is possible that you will see a W-shaped recovery, but it is still within a U shape, meaning that the overall underlying recovery is U, but along the way, it could be a jagged recovery, simply because you're coming out of a lockdown. There are periods when it will rebound, but then suddenly, because of potentially new cases coming into the picture, right, then you could have mini lockdowns in certain localities, right? So then a W-shaped recovery happens, but underlying it is still a U-shape, meaning that you probably won't see levels of GDP or output going back to pre-COVID until maybe late next year at the very earliest. Okay, so when we get questions about, is it possible we see a W-shape? I said yes, but it is still within a V-shaped recovery. Okay. Now, I think one thing to note also is that it is going to be a very uneven path. Even though we see signs of recovery, it's going to be uneven. For example, in the second and third quarters, you're going to see some economies show expansions, some show contractions, right? It depends on, you know, the size of the economy, the resilience of the economy, also what kind of stimulus that they have, and very importantly is how well they have controlled their infection rate. Okay, but I think what's important is that also to note is, unless you see globally infection rates come under control, it'll be very hard to see a stable and even path of recovery across the world, simply because at the end of the day, even as in Asia, you're an emerging market economy, you still depend on exports. And if, let's say, in US or in Europe, the situation is not under control and their borders remain closed, it will be very difficult for them to see a full recovery or meaningful recovery such that our exports to these countries will also come back to let's say, COVID or pre-pandemic. So in other words, I think overall the recovery is happening, but it will be uneven across the countries. So it also, so hence, because of that, we think that monetary fiscal stimulus will continue to remain very accommodative, meaning that these governments, central banks will continue to support the economy simply because the path of recovery will be very uneven going forward. Okay. So I think just to summarize, like as we go into the second half of 2020 and into 2021, what are some of the risks that we will expect, to affect recoveries, the shape of even how markets perform, what could drive volatilities? And I think firstly would be the pandemic, the COVID-19 pandemic, right? The extent of the pandemic, what are the measures required to control it, even after economies have reopened, right? Because of as I said, the possibility of a second or a third wave, right? Especially when some countries go into the winter months. And again, as I said, until we see all these global cases come under control, right? Traveling, full mobility, full recovery of exports, I think it will be hard to come by, right? But I think the crucial factor, of course, would be the hopes of a vaccine, right? But until that comes into the picture and it's, becomes widely or commercially available, I think the situation will be that, this pandemic risk will continue to linger. Okay, so that's the first thing. Second, of course, is geopolitics. Markets haven't talked very much. After the pandemic, everyone was so focused on pandemic, but actually the tensions, particularly between US and China, have continued. In fact, the relationship was bad before the pandemic. It's just gotten worse after the pandemic. And I think we can see in the recent week with what happened when US shut one of the consulates of the Chinese consulates, and now it seems like the tensions are re-escalating again between US and China, right? And we think that this will continue to be a driver of market volatility, and especially currencies, right? In fact, now the tensions and the rivalry has extended to who will come up with a vaccine first, right? And I think that race, between the two countries, first it was technology, it was economic power, and now it's on pharmaceuticals and vaccines. So again, we should be mindful. Of course, the question is the US elections. If, let's say, the Democrats win or Biden wins, will that change the relationship between US and China? What we think is that even if Biden wins, which at this point, the polls show that he has a very strong chance of winning, right? It wouldn't completely change, meaning that a lot of the tariffs that were imposed, we think, will still be maintained. But what Biden might do is, of course, change his approach to China. They will still maintain a hardline stance, but probably he might take a slightly different approach, a more multilateral approach to China. But essentially, we think that the medium, long term, the geopolitical risk between the two countries will continue to remain regardless of who wins the elections. But of course, having said that, the US elections, what we saw in 2016 is that it was a key event risk when Trump won. So of course, this election will also be a key event risk to watch, because naturally markets will be watching what kind of policies that a Democrat or Biden will impose if he wins, right? It will probably be quite different from Trump's approach, all right? First thing he's talked about is increasing taxes. So I think that definitely the US elections in November will be closely watched. Now, another risk, of course, naturally for Malaysia also is the commodity price movements. Okay. Now, generally, you expect commodity prices to remain in check in a pandemic scenario. Okay. So as long as the pandemic risk linger, you would assume that global oil prices will generally be lower compared to 2019 average. Okay. Now, the trend of commodity prices is important because it will drive inflation, it will drive interest rates, and we know commodity prices can be very volatile. Sometimes it's driven by factors not fundamentals, right? It's just simply sentiment. So if commodity prices go up too fast, right, it pushes up inflation and prices, right? It will also put upside risk to interest rates, which is not good in a situation where, let's say, the global recovery is still very weak, uneven, right, or a U-shaped recovery. Now, another risk is if it drops too low, it could tip some economies into debt, right, and slow economic activity. And this, as I said, particularly relevant for Malaysia, given the tightness in our fiscal position. Okay, so I'd say these are some of the key risks that I would still continue to watch going into the second half, right? And definitely that we should be mindful of, even though of course markets are very hopeful about the reopening, and also because of our vaccine hopes. So I think one thing that has been driving the markets, right, they said there's a disconnect, economic performance and also market performance, is simply because of the fiscal response from all the countries in the world, simply to support the economies during this pandemic. In fact, we've seen last week that the EU has just passed a 750 billion pandemic fund, right, to support the economies for the next 3 years. Markets are looking towards the next fiscal package from the US, okay? And even the Fed, I think in the Fed meeting next week, right, although the Fed has already cut interest rates to near zero, right, they have extended QE, right, expanding the balance sheet to over 6 trillion. But now there's talk that the Fed will do more in terms of monetary support. They might actually do what we call a yield curve control to keep the yield curve, the entire interest rate curve of US are flat. So I think the markets are now being driven by all the money, the liquidity, the fiscal, the monetary support, right? Despite that the economic indicators are still quite weak. You can see on the right-hand side table that, you know, the countries labeled in red are countries that have cut interest rates below their previous lows during the global financial crisis, meaning that their interest rates are already at record low, and that includes Malaysia. So I think in the back of our minds, we know that I think somehow because of the situation, all this fiscal and monetary support will continue to be there. And that's what's driving the market performance now, especially equities. But I think the question will be, as I said, going back to the previous slide where I showed all the risks. And I guess when markets feel that how effective are these fiscal response packages, I think those are some of the things really to keep in mind, going forward. Right, and then of course debt and fiscal risk. You know, when you pump so much liquidity, like issue bonds, right? There will definitely be a resurgence of debt and fiscal, and markets will refocus on this after they will refocus on these risks, right? Once they see some signs of recovery. Okay, so again, for some of these countries already, you can see the fiscal balance was the deficits were already high even before the pandemic. Now with the pandemic, you expect that their fiscal deficits could even double as a percentage of GDP. And then you look at the debt levels. In fact, debt levels have continued to increase since the global financial crisis. The problem with the debt levels is that it affects the path of your recovery, right? Meaning that you have to continuously support, because of high debt levels, keep interest rates low, right? And ensure that people are able to service their debt, companies or individuals. And you can see that Malaysia, right, has one of the highest debt levels. It's not just household debt, it's government debt, it's also corporate debt. So I think this will also be one of the issues going forward, how that, you know, because of high debt levels, it affects your path of recovery, how fast you can go back to pre-COVID levels, how long you have to keep interest rates low, how long you have to keep supporting these this this debt, especially if unemployment stays high, right? So I think markets will refocus on debt and fiscal risk, right, as signs of recovery resume, right, and it will definitely affect some countries with already very high debt and fiscal levels. Okay, so I think just to sum it up, again, like the global part is that to summarize the global outlook, I think after the world, unless the world can control the global infection rate, I think it's hard to see a meaningful, balanced, even recovery. Okay, of course, having a vaccine helps, right? But until then, I think there will still be lingering concerns about a second or third wave, right? And geopolitical risks still linger. And so we expect that uneven pattern of recovery, like a jagged recovery within a U-shaped recovery. We think that that will be the underlying scenario, right? Also, a key event risk to watch will be the U.S. elections in November, which could actually, again, drive market performance in terms of sector allocation and so forth. So this second part, I just wanted to share with you some of the trends that we are seeing in terms of global infection rates and global indicators, right? And also vaccine updates. See, where are we on the curve? Okay, just to show you a contrast, globally, actually, we've seen global cases have surpassed 15 million. And at 15 million, more than 15 million, right, you can see that actually the curve has not been flattened. And it's in contrast, of course, to Malaysia, where we've had some success in trying to flatten the infection curve, and hence that's why our economies were able to reopen, the MCO relaxed. So globally, where are the hotspots? And the hotspots are obviously United States, Latin America, Russia. In Asia, it's in India, Indonesia, and Philippines. You can see that the infection rate actually has continued to go up. So like I said earlier, unless we see globally these infection rates come under control, we will not be able to see a full recovery just yet. Okay, simply because there's no full mobility, borders are still closed to some of these countries, and it will be very hard demand to resume in a stable way. Now, one bright spot is the China economy, right? Now, China being first in, they are also first out to come out of this recession or this pandemic. And in a lot of the social and economic indicators, you can see that activity has resumed. In fact, in some cases, back to pre-lockdown or pre-COVID levels, right? Firstly, like passenger traffic, coal consumption, restaurant activity. They see certain areas, where they saw a spike in cases. Then after that, they reinforced their lockdown. But generally, I think things have really stabilized in China. You can also see from their second quarter GDP numbers that things have improved. Now, this is good. It's positive for Malaysia because China is our biggest trade partner, right? Now, one of the concerns during MCO is that supply disruptions, meaning that even if you have demand, you cannot supply, whether it's goods, you cannot source a lot of the goods that are needed. So because of China reopening, I think it helps Malaysia's recovery path. It helps to that Malaysia, some of the supply disruptions to ease, because China has actually stabilized. So I think this is definitely one bright spot. In fact, in our export numbers, Malaysia's export numbers, we have seen that actually in the last few months, despite contractions in exports to all the other countries, exports to China were still growing. So I think that's definitely a positive sign. Now, in terms of global indicators, right? Generally, naturally, when economies reopen, there is a rebound in some of the numbers. Hence, some people say, is it a V shape? But again, as I showed you earlier, it's not really a V shape, but it's just that it's the initial reopening that leads to some of these indicators, some of these indicators rebounding. And one of them, of course, would be the purchasing manager indices, the manufacturing indices. You can see from the top left chart that it's all recovered, in China's case, back to their pre-lockdown levels. And you can see across all the countries, Europe, US, the world, Japan, that is actually recovered after the reopening. Okay, so definitely this is a positive sign. Of course, the world MSCI, because of the amount of liquidity pumped into the system, because of market optimism on the reopening, you can see that actually global equities has been tracking higher. Commodity prices also rebounded from the lows of below 20s, right? It's all prices are back to over $40 levels. And generally, all the global COVID recovery trackers show that as economies reopen, somehow, even though infection rates are still high, there will be some initial signs of recovery or rebound. Okay, so I think all this goes to say is that, I mean, we are not out of the woods, but definitely we've seen the worst, and we are coming out of that trough. Okay, so I think this is the key message, that we are coming out of that trough simply because that markets have actually started to reopen. Okay, and one of the popular indicators or trackers is the Google Mobility. So this is the tracker for retail and social activity for all the Asian countries. And again, just to show you that when economies reopen, they relax their social restrictions, right? You can see that retail social activity recovers, right? The dates there show when these countries actually relaxed or reopened, and you can see immediately that their levels of retail social activity actually started to improve. In some cases, they are coming close to pre-lockdown level already. Right. Of course, in other cases, because infection rates are still high, for example, Philippines is still low. But generally, again, suggesting that we are moving, all these countries are moving in the right direction. Of course, all hoping that the infection rates will continue to remain under control. Okay. So finally, I mean, before I move to Malaysia, just some updates on the vaccines. I think definitely every week, every month, we are seeing a lot of positive news about the trials of the vaccines. I think they're up to phase 3. There are 4 vaccines now in large scale tests, and some of them are already showing positive results that they produce antibodies to try and counter the COVID-19 infection. But again, not a scientist, but there's still skepticism that these vaccines, the antibodies, may not be produced in large amounts or long enough, meaning that if you have a vaccine, right, you may still need to take 2 doses of this vaccine every year, meaning that every few months you need to take the vaccine again, just to ensure that you are immune, right? The immunity stays effective. So again, this part is still uncertain. Of course, it's positive. The news flow is positive. That's also, I think, one concern is that even if you have a vaccine in countries like US, they're worried that people don't want to take it for whatever reason. They don't want to take this vaccine. So again, then if large numbers of people don't want to take it, or because of the cost, then it's really not that effective, right? So, but definitely, I think the news of when the vaccine comes out and produced in large doses and hits the markets will definitely be a changer in I think definitely in terms of the markets, and also in terms of hope that we could see some form of normality soon. Okay, so I think definitely this is something that everyone is watching, right? But again, there's, on the other side of it, there's also concern that again, about the efficacy of these vaccines, right? So now coming to Malaysia, I think on the topic of recovery, right? Definitely we are in the recovery phase already. All the indicators suggest that. Okay, I think the question is really how strong a recovery, right? And again, how strong a recovery is very subjective. Okay, especially in the current economic and political landscape. Okay, so ever since the pandemic started, you can see actually the government, the authorities, Bank Negara have all been very proactive, cutting rates, announced fiscal packages. Then we had the MCO, the different stages of MCO, and leading up to the recovery phase now. right? And of course, the latest action was when Bank Negara cut interest rates again by another 25 basis points, bringing our Malaysia interest rates to a record low, right, in July. So of course, the question is, what's next? Okay, so obviously, I think there will be supposed to be another medium long-term economic recovery plan announced in October. Before that, of course, there's also a Bank Negara meeting in September, and then we're expecting the budget sometime in November, right? But again, as I said, I showed you earlier the charts, interest rates already a record low, fiscal stimulus already with 295 billion package. It's a lot. We've done actually quite a lot already. So that's why I said we are seeing signs of recovery. Okay, as you can see here, you expect that consumer sentiment, business conditions would be bad first Q. But I do think that going into 2Q, 3Q, we will see some recovery, some improvements, right? In fact, in the trade numbers, we are already seeing that the declines are starting to narrow. In terms of retail sales, we are seeing, of course, naturally a move to online sales. Demand for essential goods like food, for pharmaceuticals, groceries, even electronic equipment is still fairly strong, right? And in terms of the services subsectors, we have actually seen a rebound, meaning it's not positive, it's still contracting, but at least a smaller contraction in May. And that was because of the relaxation of MCO after the Labor Day weekend, right? So you're seeing actually activity, at least it's rebounded from the trough, right? So definitely, I think there are signs of recovery. And again, the Google mobility, you see in all areas of like retail, recreation, social activity, that things are actually improving. You go out, you can see traffic jams, you can see people are going about their lives, they are starting to dine out. Even the PMI numbers, of course, the manufacturing PMI has rebounded ahead of the export numbers, but of course, so we are watching to see whether export and Malaysia's industrial production will actually start to move in tandem with the manufacturing PMI. But definitely it shows that we are out of that trough. Now, we don't have data on bankruptcy, okay, but we have numbers on registered local companies. And interestingly, it shows that actually in May and June, the number of local companies registered has actually started to increase, right? And the latest number, the leading index, actually recovered, it showed an expansion of 0.6%. So what we usually use leading indicators is to as an index that leads the GDP trend. And what it would say is that it's in line with what we are out thinking, is that GDP has probably hit the worst in the second quarter and should show a smaller contraction going into the third Q, simply because our economy has reopened, MCO has been relaxed. So generally all the indicators suggesting that things are on the right track. Okay, of course the question is whether this recovery is strong enough and whether we can avert another round of a second wave and avoid other mini lockdowns. Yeah. Now, one area of weakness, right, that we expect will remain a weak point or focus point despite the recovery is the labor market. Okay, unemployment rate, even in May when MCO is relaxed, you can see that the rate that sign saying that the loss of employment has actually been gradually coming down. I mean, there's still high number of people losing jobs, but it's smaller. The employee retention program, the government's wage subsidy program, we are seeing fewer applications and fewer recipients, suggesting maybe some of the pressures in the labor market is starting to ease. Okay, now don't get me wrong. I mean, I think that this pressure will remain, right? Simply because I think some jobs that are lost will not come back, right? Simply because of structural reasons, and also because companies are still cautious about re-employing and expanding. And of course, the concern is what happens when the moratorium ends in September. So this will remain a risk. And for this reason also, that's why we feel that private consumption GDP may not recover to the full potential for some time until you see that there is meaningful employment recovery, a meaningful recovery in employment again. Okay. Now, so I think just to move to maybe some more of a balanced view on exports, right? What we're saying is that we are showing here is that, you know, although the headline export numbers were bad, there were some segments that have done very well. Interestingly, in the first 5 months of the year, actually, in terms of the magnitude of growth, right, we actually see that some areas, naturally rubber gloves, but even office machinery, oils, aircraft, iron and steel bars, the exports of these products actually shot up in the first 5 months of the year. Right. Of course, in contrast, there were declines in some other sectors like the motor commodity sectors. But I guess this is just to show that Malaysia's export base is fairly diversified, meaning that in periods when commodity prices were doing great, we saw strong growth in the commodity side. But now in this current period, we are still seeing growth in some other segments of our export base, particularly rubber gloves or iron and steel bars, you know. So again, going to say that we have a fairly diversified export base, and obviously meaning that if you're going about your investment decisions, there are probably still some segments that you can spot growth and potential in. Right. So I think next would be, I think, talking about the fiscal support. Right. I think the question we get asked is, what else can government do? You know, as I said, there are a few more plans. There's still the budget in November. What else can the government do to support the economy? I mean, they're actually in a tight position. They have announced 295 billion. Only 45 billion fiscal injection, meaning it comes directly out of the government's coffers, right? And if you include the 8 billion of tax incentives, then it's 53 billion. But whatever it is, because of the drop in oil prices, you can see that our fiscal deficit has obviously, you know, widened to expected to widen, at least double to 6% of GDP this year. And in terms of the federal government debt position, expected to exceed the threshold of 55% of GDP. So I think in this current parliament session, we actually expect that the government will raise the threshold. Now we currently have a 55% of GDP debt threshold, meaning we don't exceed it. But because of the current pandemic situation, they are likely to appeal to Parliament that they need to raise that ceiling. How much they raise that ceiling, I guess possibly to 60 or 65% of GDP, right? And this actually happened before in the past during crisis episodes, so it's not a surprise that they will do it again. But again, as I said, the issue is that markets, you know, investors will refocus on this fiscal and debt risk once, you know, at some point they will refocus on this fiscal and debt risk. So that's definitely something that we have to be wary about. Okay. At a glance, the package, what is the progress of implementation? I mean, generally, I think the key ones have been good. It shows good progress, especially the cash handouts, even EPF reductions, the SME soft loan funds. I think that has been progressing effectively. They allocated close to 13 billion, so at least 9 billion already has been approved. The loan moratorium, obviously, but again, the loan moratorium, a sticking point would be what's going to happen after the loan moratorium ends in September. So, generally, I would say the fiscal package progressing. Hence, I think progressing, but I think still some way to go because some of these measures have been extended until year end, right? So, and I think given the fiscal situation, I think it'll be hard to expect very much more. Okay. And I think if there are going to be new projects announced, we think that it's more likely to be announced in the 12 Malaysia plan, because that will be a multi-year plan, and a lot of these big scale projects will be multi-year projects. So we think that if you're hoping for announcements of projects, we think it's more likely to be 12 Malaysia plan, which will be announced in January next year. Okay, so in a nutshell, what are our GDP projections for Malaysia? We are looking at 3.5% contraction for this year, a recovery to 4.3% next year, 4.3% growth next year. Okay, our numbers are more conservative than Bank Negara's. Bank Negara projecting a range of -2% to plus 0.5%. But I think the guidance is that they are like that it could be lower than what they are currently projecting. Okay, and again, these numbers assume that we will see at least a 12 to 13% decline in the second quarter, a smaller GDP contraction, maybe about 4% in the third quarter, and before achieving a small marginal growth in the fourth quarter. Okay, and this assumes again the pandemic effects continue to abate. All right. Now, something of interest is the foreign funds returning to bonds. So despite what we've seen, whether it's a concern on economic performance, its politics, or its fiscal or debt risk, looks like because of the large amounts of liquidity, QE, you are seeing funds returning to Malaysia's bond markets in the second quarter. Okay, and but in terms of equities, they are still net sellers. But of course, what's holding up the local equity markets is the domestic retail participation. Okay, so I guess at some point the hope is that because of the attractiveness of our bond yields, right, the returns that they're offering, that the funds will actually continue to come back into our bond markets, and also because of the equity performance so far, that they will also start to return to our equity markets, right, and that would help to keep the ringgit stable. Right, in terms of interest rates, it's hit a record low of 1.75%. We think that Bank Negara may cut again because they left the door open, and again it's a question of how strong a recovery. Like I said, we see signs of recovery, but whether it's good enough, it's strong enough. And the next meeting is in September, and I think that a key question would be on the position of the loan moratorium, because as I said, the loan moratorium we saw earlier, the figures show that it helps. The value of the moratorium now is 55 billion, of which more than 30 billion involves individuals and households. So when the moratorium ends and this 55 billion is taken out of the economy, right, because people have to start servicing their loans again and their interest payments, right, is the economy strong enough at that point, right? So if not, maybe there's a need, if they think that they feel that there may still be a need to cut interest rates further. So that's why we say it's still a 50-50 chance, and because Bank Negara left the door open, there is still a possibility of further OPR cuts. Okay, this would be my second last slide. We have had questions about what is the risk of a sovereign rating downgrade. So far, 2 rating agencies have lowered Malaysia's outlook to negative, okay, simply because of the economic risks, also because of the debt and the fiscal risks, right? You can see from the bottom right chart that we are seeing that debt levels for Malaysia has actually been rising relative to a lot of other countries. So I would say that the risk is not, I think for now, because typically rating agencies take a medium-term view on the fiscal and the debt position. So meaning that I think they're probably watching to see what Malaysia does in terms of policy measures during a year when we are recovering. So if we are expected to recover in 2021, as in recover meaning we see positive growth, they want to see what kind of policies that the government implements to improve the fiscal position. I think that's a fair gauge before you decide whether you want to downgrade a country's rating. Okay, so I'd say for now, we are still, I think we can probably avert an actual downgrade, but the negative outlook will still be there. Right. Okay, I think last but not least, I actually had one more slide. see. Okay, but never mind. The last slide actually really was just to talk about the ringgit outlook. The view is actually we expect the dollar will actually the dollar strength will subside. It will subside simply because we think that there's a lot of liquidity in the system, and we think that liquidity is moving towards emerging markets because of hopes of recovery, and also generally in Asia, in parts of Asia, that we've actually managed to keep the infection rates under control. And because of this Asia recovery story, we think that the funds will come back to the region, and also we think that the renminbi so far has remained stable. So on that note, with commodity prices also stabilizing, we think that the ringgit should actually continue to stay around these levels, maybe 425 by the end of the year. And because of expectations of again a recovery, meaning a positive growth for Malaysia next year, we think that there's a possibility that also the ringgit could recover below 420 against the US dollar next year. Okay. All right. So I will end my presentation here.
Okay. Good morning, everybody. Sorry for the technical glitch. Not sure what happened. We tried the system yesterday with the same laptop and it worked quite well. But without further ado, let me start by saying that it's been a sensational year, needless to say, and as the title suggests, a little bit of magical year, especially if you own glove stocks. And for this upcoming half, the second half, is going to be a tale of two halves with distinct investment strategies. And just a quick review on the half that's passed. It's been really a half of contrasting superlatives, all right? The quickest formation in history of a bear market, coupled by the quickest formation of a bull market for Malaysia. Of course, that's driven a lot by the rubber glove manufacturers. And of course, you know, in our lifetimes, I thought we've never seen oil future prices going down to as high as almost -40, like even below freezing point, right? And for the first time, when they talk to funds and locals, there's this FOMO of not owning enough glove stocks. Now, looking forward to the second half, again, is a half of two distinct strategies. In the third quarter, we believe we should be in what I call a PPE mode, personal protective equities mode, where I believe that market, or rather the Main Street stocks, will be more aligned to the economic woes that we're facing today. But it's a good thing because it will allow us to buy into dips. In this particular quarter, we're expecting glove manufacturers to reach on at least through this reporting season, upcoming reporting season. We expect the e-government investment team to work out as well, along with a modest impact on border reopening. So we're still looking forward to some travel bubbles being formed in the next weeks or perhaps few months to come. That doesn't tantamount to a full reopening play, which will only be prevalent in sometime in the fourth quarter when the vaccine find is made. And actually, for this team to work out, you don't really need exactly a vaccine find, but the mindset that the vaccine would be found or effective cure will be found, and that's going to provide some uplift to the cyclical rebound as well as the small caps focus. Throughout these both halves, the yield compression investment team should work out quite well. It hasn't gained much prominence so far this year, but we believe that as the market consolidates and there's a bit of risk aversion creeping in, that a theme will be more and more relevant. Now, just to give you a sense, when we published our outlook report about 3-4 weeks ago, we were looking at conservatively a year-end target of 1520 for KLCI. And at the same time, at the time that we wrote, our bottom out was around closer to about 1580, 1590 already, yeah. And that is based on, for reference, top glove at about 22 ringgit target price. TP has been raised gradually over time, and you won't be surprised to see further rise in target prices, in the coming weeks as well. So just to provide you with a sense of where the blue sky can be for KLCI, it's actually blown through 1630, as you all know, which is based on the at that point in time about 25 top glove. But now with some of the brokers even looking at beyond 40, which I think is unachievable. But for argument's sake, let's say if it hits 30, then our blue sky for KLCI will be about 1700. So again, I rather be conservative at this point in time to maintain this 1520 target, because not all stocks are going to hit target prices, especially your so-called main street stocks. Not by year end anyway. And at the same time, everything depends on where glove companies end up the year. And as Julius I mentioned earlier on, right, if a vaccine is found, and expectations will be running up towards year end for that find, the mindset again may cause some profit taking on glove companies. Now, back to our view that the market should consolidate by the third quarter. And again, if you look at the various road bumps ahead, the biggest issue or biggest thing to watch out for is the end of the loan moratorium at the end of September. And that's going to create two issues. One is the liquidity on the stock market will be taken out. Anecdotally, and you talk to your friends and for those who are running businesses as well, you know that a fair bit of moratorium money is being diverted to the market at this point in time. And you're talking about huge amounts of money, right? And as for reference, if you look at the data provided by Moody on the top right chart, you can see that Malaysia is dependent on moratorium money, or usage of the moratorium money is fairly high. So when that happens, of course, banks are going to be arranging more for the relaxation, restructuring exercises, right? For example, the likes of CIMB, for example, was forecasting that they may need to restructure maybe 30 to 35% of their clients' loan books, post end of moratorium. Even with that, I believe that a lot of corporates, even retailers, will need to pull out some money off from the equity markets. At the same time, the real economic spending will also come off. Again, anecdotally, you get a sense that a lot of what so-called prihatin penjara money is being spent at this point in time, and perhaps could be spent at an abandonment, in the sense that no savings are being made to prepare for a resumption of loan repayments towards October onwards. So when that happens, what you will see is that vicious cycle of stay-at-home mode causing more than expected business closures, job cuts, and pay cuts, which again leads to weaker consumption overall, and that leads to downside to the economic expectations. And our assessment, of course, takes into the fact that even though Malaysia has done its best, it's done a lot to provide fiscal stimulus, but the direct fiscal injection, unfortunately, it's I would make the analogy of it is akin to having a water gun compared to a machine gun that the likes of Singapore and US have used, right? So 3% of GDP, which pales in comparison to as high as 20%, which Singapore has deployed to ensure that the consumption recovers quickly. I won't go through the economic forecast, which Julie has run through again before, but part of my assessment rests on this more like personal view, that the real unemployment rate out there is probably will peak at over 10%. So the Department of Stats numbers of 5.3% for May seems to be too mild, right? So when you talk to various job agencies, for example, you get a sense that up to maybe 2 million people could be looking for or actively looking for jobs, part-time or full-time. And the bigger issue is, of course, a chronic fiscal deficit situation we may be facing, right? So although we are in keeping with the Ministry of Finance guidance that fiscal deficit will not be over 6% for this year, but just if you just do a simple mathematical calculation on the previous budget forecast, and if you assume, like, say, a 20% shortfall in the forecast, and then you add in a good amount of the additional direct fiscal injection, you can get something like over 7% easily for fiscal deficit. But of course, that could be spread out through until 2021. So that would also mean that 2021 fiscal deficit will remain elevated. So I believe Julia is still keeping to her 5.5% fiscal deficit forecast for 2021. All that spells out into lacking earnings vitality in recovery. So while we're looking for overall earnings to recover by 22% in 2021, compared to 15% contraction, but the absolute earnings, if you aggregate it in 2021, will still be below that of 2019. And there could be, of course, some shortfall as economic consumption trends weaken, right? And unlike other markets, right, there's no clear signs of revenge spending to indicate that people are coming out strongly to spend again, even if you factor in online purchases, right? So from all various channel checks, we can see that consistently spending in most sectors are down, right? And that's partly because of social distancing requirements, but it also has to do with people's thinner pockets these days, I believe. To give you a case in point, right? When you talk to the various shopping mall operators, they tell you that the traffic is back to maybe 70+% of the pre-MCO days. But I would bet that the actual spending will still be lower than that kind of traffic statistics. So if you talk to your friends or business owners, you get the sense that there's going to be more further business closures being planned throughout the rest of the year. On matter of politics, I've got two things to highlight. Number one is that effectively, I do not expect major changes in policies anymore, even though you may have slight tweakings in terms of the ruling coalition. And the reason why I say that is that under the present administration, you can see that the practice is trending towards the old UMNO ways of practice. And going forward, right, when the snap election is called, and there seems to be an indication that snap elections will be called by October, UMNO is going to rise more to prominence, obviously, in terms of its popularity. And even that happens, again, it won't affect the current policies in place. But the long-term implications for this new political reality is that I believe, right, it's going to lead to structurally high fiscal deficit. And why I say that is that effectively you're going to have very loose coalitions, very loose gabungans in the future. And to take care of all the members of the gabungan, more so like in the past situation, you're going to have high administrative cost that effectively leads to structurally high budget deficit. And the implications of that long term, of course, not in the near term, but long term, is that the country's interest costs will be higher than necessary or optimum. And that's going to lead to downside pressure for the ringgit. Quick news thing before we move on to market strategy is that if loan moratorium is extended, and we believe that it's not going to be formally extended, but the market will know that banks will be actively restructuring loans. That happens. Good news is that based on the precedent set by Australia, where the moratorium has been extended to December, bank stocks did not move much or did not fall by much in Australia. So the good news is that in Malaysia, I don't think there's going to be any need of selling. But having said that, the market's going to be factoring in a longer tail end for recoveries because of the overhang in bad loans. Now, onto the strategy again. We are expecting or we are prescribing a two-stage investment strategy around stage 1, roughly in the third quarter, perhaps up to fourth quarter, the PPE mode, market consolidation mode, and before the market opening up to the containment mode. So I just want to highlight the containment mode again. I need to stress, it's very important to stress that the containment mode does not need a vaccine to be found. All it needs is investors to position for the vaccine to be found, and that will change the investment strategy, especially in terms of in the view on glove, short-term view on gloves. So we can see that there's a lot of progress being made of late, and the more important thing is that it's not just about vaccine being found, right? What if infection rates peak? You know that the US is starting to mandate more and more of the wearing of masks, but of course we have a lot of stubborn Americans which are helping our glove exporters, which is great. But if they come to their senses, combined with effective enough cure or vaccine, then the usage of gloves may be coming down in the future. And that's why in this kind of state of containment mode, if you will, you may see hefty profit taking for what the real PPE plays are, which obviously would be glove companies. But at the same time, it will be good for companies that benefits from the reopening plays, i.e. the more cyclical companies. Now, before we talk about the investment themes, I just want to highlight that in terms of the sectors that we like, the near-term sector that will provide the alpha return is still glove manufacturers. Again, I feel that it's going to be relevant through at least this reporting season, through August. Tech has done very well. It's gone up in the range, but in terms of the real economic news developments, you need that to be tied in with the opening or partial reopening of Malaysia's borders for the FDI theme, the trade diversion theme, to gain a lot more prominence. The rest of the stocks that we like, or sectors that we like, are generally considered defensive sectors and high-yielding sectors. We are underweight at this point in time, particularly the aviation stocks. So these are the investment themes that we are recommending. The investment themes are dependent on the various events, upcoming events which we expect. So for the third quarter, we expect explosive growth for the glove manufacturers, and that's going to be revealed, and we'll talk about that in a short while. E-government contracts, reopening play, or border reopening play, and FPSO win, particularly for the likes of Vincent. Now we expect that to happen in August compared to July. For fourth quarter, again, it's going to be related to the border reopening. So the reopening play will gain a bit more prominence as the containment mode takes grip, and that will also help be another booster for the E&E companies. Now, this is the most important slide, right, for most people on the rubber gloves. For these slides, I want to give 3 takeaways, right? The first takeaway is, again, I need to emphasize that this reporting season will be fairly exciting, because not only are you going to see strong earnings, very strong earnings, but also exceptionally strong guidances going forward. So how high can they get, right? That's the second key point. Well, if you do a blue sky, of our analysts come out with a blue sky for, say, top glove, it can hit theoretically as high as 46. I am not recommending that it's going to go to 46. But if you just do a number crunching of potential profits for top glove, I think analysts' forecasts are trending towards a base case of between 4 to 6 billion ringgit net profit for FY21, with a blue sky of maybe even closer to 10 billion. But of course, that assumes that the everything goes perfect. And you know, in life, nothing goes perfect, right? So at some point in time, I can imagine where the glove earnings go up, but there'll be a sell down on the stocks because of the potential vaccine cure or cure being found. Beyond that period, of course, gloves are going to be able to sustain at a certain price level. There'll be a new normal for gloves because you will have sustained demand for the non-traditional markets, such as your F&B markets. And at that point in time, just to give you a first cut assessment by our analysts, of course, these numbers are very fluid, right? But he believes that post under the new normal, let's say based on 2022 earnings, where top glove earnings can be still hovering around 1 plus, maybe 2 billion, then you will have a new target price or sustainable target price of top glove of 22. But it's a fair price, right? Meaning that the share price on the way down can still break below that level. So it's just indicative at this point in time. Yeah. And the indicative top glove price, target price is around 33. We have not officially upgraded it, but just want to give you a sense of where the share price can be based on the new data that we're getting on selling prices for gloves. And the second theme relates to dividend yielders. Again, this theme has not gained much prominence this year, a bit of a surprise. What we've done is to show you a plot of the net yield, i.e. the yield of the market minus the long-term bond yields. Yeah? And if you look at this left-hand chart compared to the interest rates, and we use our cluster of high-yielding stocks compared to the long-term interest rates, unfortunately, the correlation is not high. Yeah, the correlation for yield compression theme may not be so high, but what I wanted to show is at the end of the day, you will still have the yields coming down again. Yeah, yield compression, because the alternative investments opportunities will simmer down. Yeah, even your commodities and gold, when they reach a certain price, those who take the profit will probably need to put into something a bit more certain, such as high yielding stocks. So among our high yielders that we recommend, we have the likes of BAT, which announced quite decent results already, and the share price is moving slowly inching upwards, and MQ REIT, where the upcoming results, since they pay only on twice a year, the second quarter results will pay as high as 5% yield, 4+%, 5. Then you have this next category of back-ended yield plays such as Genting and Tenaga because of special dividends that we expect. So those stocks will only gain a bit more prominence towards perhaps year-end or beginning of next year. On e-government plays, just to highlight quickly, that we still expect the e-visa project and the NIIS project to be awarded soon. The word is, of course, it will be awarded before election takes place. And the front runner for the e-visa project is my EG. And just to give you an indication, right, we previously had a TP of 147 or 150 for my EG. If they were to win this e-visa project, and it's going to be a tripartite consortium, their 1/3 stake in that consortium should ensure that the share price moves back up to about 2 ringgit and above. On the border reopening plays, again, it's just a modest boost because it's not a full border reopening play. It will, of course, elevate the aviation the most, followed by Sin stocks and Pavilion REIT. Yeah, Sin stocks such as your breweries and tobacco, they depend about 10% of their sales from the duty-free market, and especially for BAT, because a lot of their premium cigarettes sales are made through duty-free, and that's good for margins. So the best play for this partial border reopening play would be for, of course, your BAT and your Genting Malaysia, which probably would, for Gen M, they're probably profitable only about 50% of what they were before the MCO. Now, the next theme relates to the new social distancing behavior beneficiaries. So, by far, my EG would be one of the key beneficiaries, not just in Malaysia, but overall in the years to come. Hopefully, they'll be able to spread their dominance or role in the regional markets, especially for Philippines. But the work from home obviously has been a big booster to the consumer electronics seller like VSD, which we've highlighted in our previous presentation. And also the upcoming baby boom, right, post MCO period. This is expected sometime in the fourth quarter. Of course, it will be benefiting mother care retailers as well as diaper producers, right? Just to highlight, mention in passing. We don't cover all of these companies, but just to acknowledge that these guys will benefit. Now, further musings on other sectors, just want to highlight two things. So I think the common question would be, with general election coming around the corner, including Sarawak's election expected to be in November, will it be providing an uplift for politically linked stocks or construction stocks? At this point in time, for construction stocks, probably not so much, because again, we tie that to the fact that Malaysia's fiscal situation, the federal government's fiscal situation is quite tight. So you don't expect a quick rollout, strong implementation of mega projects. And again, the new reality is for construction companies or mega projects is that the margins will never revert back to the good old days. Now, on banks, my take is actually it's more of a tactical underperformance. Yeah, so a tactical underweight for now. What we wanted to highlight this particular slide is bank valuations have been coming down over the past decade, and is justifiable given that there's strong correlation between bank ROEs, which is expected to hit about maybe only 7.5% next year, to the bank price to book currently, which is below 1. So that situation will persist. Yeah. So even if there's a reopening play, I don't think banks are going to do that well. At the best, they can track the market. That's all. In the meanwhile, there are potential downside triggers, right? Should the situation of NPLs rise more than expected. Coming down to our last two slides, our top picks, as you can see on this page, I just want to highlight a couple of things. First, of course, we believe that Top Glove will continue to provide a bit of upside. This is our formal target price at this point, but again, the previous slide have shown you the indicative upgrade to our target price expectations. So there's still a short-term good upside. Apart from Top Glove, of course, we believe that a good beta play would be Supermax. And Kosan is also a good laggard play. Apart from that, what is timely in terms of a large cap would be PPB, because the impending listing of Wilmar, its subsidiaries' Chinese operations, looks very promising, especially with the run-up in Chinese equities. So we believe that it is very possible for PPB to move up beyond our target price. When we do our blue sky scenario, we get a target price of over 21 ringgit. And it's something we expect in weeks to come. And in weeks to come as well, we would expect Vincent to secure a second FPSO project from Brazil. And with that, we expect the share price to quickly reach our TP of 7 ringgit. Just a few other mentions. Again, when we release our report, Dor Pharma was very cheap, but with the recent run of pharmaceutical companies, with the fuzzy idea that these companies will have a role in the vaccine distribution, I think the share price have gone way above its fundamental value. So we will have to wait for the share price to come down a lot more before we recommend it. So what works for us in the small and mid cap recommendations are your BAT. They just released results, and they're quite positive on the outlook for the upcoming quarter, and MRCB Quill, where you get assured yield of close to 10%, and that by alone should provide a bit of a upside catalyst. I consider the likes of Syntex and Globetronics to be more towards back-ended to the year. Again, it's tied to the phone launch cycle, as well as the border reopening or FDI trade diversion play, which should benefit also VS industry. And the VS industry is listed in our other timely picks. Again, the E&E play should only gain more prominence in the fourth quarter. But for VS, they're quite hopeful of securing another multinational client. This time around, perhaps may not be consumer electronics, but maybe in the medical line. So I won't elaborate the rest of the stocks that we have here in our slides. This is where I will stop the presentation and bid everybody good luck for their trading strategies.